Okay, Rod, good morning. Good morning, everybody. We've got Rod and Sarah working in the back room there. Rod, can you hear me?
Absolutely. Good to go,
Okay,
Derek.
good. Well, Merry Christmas and Happy New Year, everybody. If you know the composer of that song, I'll give you a clue. It's called Father Christmas. If you know who it is, we'll have a special prize for you. Okay, you punch the person's name in. One clue: he's British. Okay, so Happy New Year, everyone. Glad that you're here. We've got a session here that will sort of look back at last year, and then we'll start thinking about what's going to happen to the apartment industry this year. So, Rod, let's go with the slides. I see we're using Zoom meetings here, so people can have their cameras on and they can go to full view and see the people on here. If you choose to turn on your camera, you might want to do that. Makes the meeting a little bit more fun. Okay, so Rod, if we could go to slides. And okay, good. So I'm going to go the right view. Okay, so I'm going to start with what do I think is an extraordinarily interesting graph. Okay, so everybody should be able to see the slide there, right? Someone said John Lennon. No, it sounds like John Lennon. Try again. Okay. Okay, so the graph that you see here was in the Globe and Mail, and there's two lines there. There's a pink line, okay, and there is a blue line. Okay, and the pink line represents prime, okay, and the blue or the greenish line represents inflation. And this is over 40 years, okay? So put your screen on there so that you can see the slide, okay? And have a look at it very closely. And then we're gonna ask you a question here, really, okay? And the question is, so remember, the pink line is prime, and it goes up and down, and the other line, the blue or the green line, is the inflation rate, right? So you'll notice something from here, okay? And we're gonna ask you a question. Oh my gosh, you guys are trying hard. Keith Emerson, Ray Davies. Keith Emerson is close. All right, so here's the question. Here's the poll question we're going to ask. And listen to the question, okay? Because it's not asking your opinion. It's saying, based on this graph. Rod, can the question come up?
Yep, so let's pull up. I know we won't be able to see it.
Right. So based on this chart, understanding that the purple line is prime and the turquoise line is interest, is interest rates, right? Is inflation. You get what I'm saying, right? So based on this chart, where do you think interest rates and prime are going? Is it going up? Is it going down? Is it remaining the same? Or do you have a different answer, right? But there's a really consistent trend here from year to year. It's almost consistent for 40 years, except for right now, right? So let's everyone answer that, and then we'll see. Because look, everyone's got an opinion on interest rates. I'm thinking, what is the data telling me, right? Or what is the data telling us? So Rod, we give him 5 seconds.
Yeah. Okay, Sarah, do we have results?
Yeah, that's what the results are actually telling us, because when you look at this graph closely, you'll see that prime is always higher than inflation. Rarely does it go below, okay? And so right now, prime is lower than inflation. And historically, prime is always higher than inflation. So unless we tame inflation really quickly, prime is going up. That's not an opinion. That's just saying historically, that's what we've done. And look, we live in a very different world today. Policy changes occur quickly and things like that. But I just thought this graph was very interesting. And if you want to know the future, sort of look to the past. And the past says that prime is always higher than inflation. So, I think that most of you sort of get that. You'll see there are a couple of times here where these lines do cross, but they only cross for very short periods of time. Okay, Rod, slide. So today's topics, right? So we want to talk about what's happening in the apartment industry for 2023, right? What are the big guys doing? right? We want to talk about what the smaller guys are doing, right? And I think roles may be switching. Buyers may be becoming sellers, sellers may be becoming buyers. What are we doing? Well, we are a company of, not a big company, but we're 28 people. We can move fairly quickly. We definitely think for us, this is going to be a pivot year, and we're going to tell you what we're planning on doing for the year. And then we think that one of the best opportunities for the year is affordable housing. And we're going to talk a bit on affordable housing. You know, I think there's a phrase that all of you know, never fight City Hall, right? And if the government is spending money on something, then I think it kind of behooves you to follow what they're doing and sort of go where the money's going. Okay, Rod, slide. Right. So I think that 2023 is, and I think everybody agrees, it's going to be a year of disruption. It's not going to be last year. Well, and if you think about last year wasn't 1 year. The first 6 months of last year were a different year than the second 6 months of last year. So last year felt like 2 years. Certainly in brokerage it is. We did great brokerage from January to June. Some of those deals closed after June, but they were baked basically. And but I would say that after July of 2023, it was a very different market. And I'm going to talk about where the pitfalls and the opportunities are. So if you had a 10-year last year, sort of 10 out of 10, a great year, and you probably would have had if you're in the brokerage business, you would have had to have a better first half because the second half, wasn't that good. I think next year, if you think about a disruption, which is coming, okay, don't know how much, what it is, but disruption's coming. You multiply that by creativity, it equals opportunity, okay? You're going to have a 9.5 year, okay? It might not be last year or the year before, but with creativity and thinking and being nimble, I think you could still have a very decent year. We expect to have a very strong year next year because it's not the same old. And I think for a lot of people, if you're doing the same old, it's not going to be, such a great year. So let's talk about what the disruptors are. Well, I think we know all these things, but construction costs are high, but good news is they're leveling off. And I think to some extent coming down. Certainly lumber went shoot like this and then, back down again. Interest rates are high for sure. Liquidity is a challenge. If you're selling a building, right now there's a delta between the buyers and the seller's price. And people call this discovery pricing, like we're trying to discover what the new price is. Financing is a challenge for sure. Banks being careful, doing what they call relationship lending. And then apartment land is both a challenge, I think, if you bought it recently, but it's also an opportunity if you are a buyer of land, because that's probably where liquidity and the challenges are going to come up the most. You probably tell I'm suffering from a bit of a cold, so if I do go off for a minute, if I go on mute for a minute, you'll understand why. Okay. All right. Right. Next slide. So I've shown this slide a few times. It's sort of related to the other slide that I showed, but it's specific to cap rates. The yellow line is the buyer IRR targets. This is US data, by the way, from a guy named Ron Witten. We don't have in Canada, for a number of reasons, we don't have the transparency, we don't have the services here, and we don't have the deal flow here that you can, draw lines this accurately in terms of, what happens in the marketplace. But it's a very interesting graph. So the yellow line is buyer IRR target. So what do buyers expect to get for a return? Well, the unsafer the world gets, sort of the safer apartments get. So maybe I'll own apartments. I don't get the same yield as I'm going to get on another asset class because I'm getting safety in apartments. So buyer IRR targets have been going down historically. And cap rates, which are the other side of the coin for buyer IRRs, follow. So you can see that the green line, interest rate and cap rates, right, was, yes, Greg Lake, very good. Andy and Anderson, good. Bonus for Ernie Lucursi, yes. So the yellow line and the green line track, right? Makes sense, right? Now, the blue line is interest rates, and that's really what we're talking about here, right? Where interest rates going to go. So you can see that the blue line and the green line do not track. So when people say interest rates have gone up, therefore cap rates have gone up, people will say, well, cap rates should go up. Well, yeah, if you could tell me cap rates were going up forever, interest rates are going up forever, then cap rates would go up. But no one's saying interest rates are going up forever, right? A lot of people are saying this is going to be a 1 or 2 year problem. We're going to go back to lower interest rates, not 2% again, right? But not where we are right now at, 5, 6 or something like that. So what's interesting to track, and that's the bar graph below, is the spread between interest rates and cap rates. And you'll see that that spread is not consistent. You see that bar graph at the bottom right, if you point to it, there are times where there's a big spread between interest rates and cap rates. There's a time where there's a very small spread, right? So I don't think that anyone can say, especially when you see the data, that interest rates and cap rates are tied together. There's certainly not 100% correlation. The actual numbers, if you do the math, it's a 0.62 correlation. So 0.62 correlation, meaning that when interest rates go up, cap rates turn up. Not how much they turn up, just the fact that they turn up, right? So like almost 40% of the time when interest rates go up, cap rates don't even change direction. So I think the sort of prediction is that buyer IRR expectations are going to get muted. That's the yellow line going flat. Cap rates are going flat, but maybe not flat. Maybe they're going to go up a little, then they're going to come back down again. And interest rates are probably trending up, meaning the gap between cap rates and interest rate narrows again. But here's the point, like it has in the past, right? And so this is not the first time this is happening. And so I don't know where cap rates go, but I don't think it's as bad as it is probably in other asset classes where there's probably much more of a correlation because of the stability that apartments have. Okay, next slide, please. So where's the opportunity? We're looking at a new year. We think that apartments in general are just going to be fine. Most apartment owners are in very strong shape. All the public companies are in strong shape. But we think that apartment development that has started with developers who are not strong financially. So if you're a pension fund and you're building an apartment building and interest rates go up, doesn't matter, right? You've got cash to put in the deal if you need it, and you probably have such low leverage, it doesn't matter. But if you're a smaller developer, let's call it a B developer, and you are with a B lender, right? And you've got the capital stack, like maybe 75% construction financing, 15% mezz financing, and then the last 10% is a sort of 80-20 split between the developer and the joint venture partner. Well, with interest rates rising and the takeout financing now much higher than your projection, the cap rate may be a little higher than your projection, the bank is going to get nervous about paying back the construction loan because maybe the value is not going to be there, right? With the higher interest rates and a different cap rate. So we think that there's an opportunity to recapitalize existing apartment deals. We've completed one already. And we've got several more in the pipeline. So what we're saying is the majority of our clients are developers building new apartment construction. I think the smaller ones and the ones that are highly leveraged are going to need more money. For that, they're going to give up a piece of ownership. They're going to give you a promissory note. They're going to do something to make this attractive for you. And we think that people seeking active returns, but passively without doing the work, might have a very good opportunity in recapitalizing new apartment deals. We're doing a specific seminar on this for 2 hours on February 2nd. And maybe, Rod, you can pop the link into there, right? And we're going to talk about the different ways that you restructure new apartment construction deals from the private. And we think there's going to be more private people doing this. And we think that, cash is king. Cash is going to be king for the next probably couple of years. So in the apartment business in general, if you're an apartment owner, just focus on your existing building. Rents are still going up. I mean, we have a lot of disagreement on, just when you talk to the commercial real estate community, but the one thing everybody agrees is that rents are going up. We've got a real shortage of rental housing already. We've got strong immigration. All the things are saying that rental rates are going to go up. The only threat to that is probably legislation. Other than that, it looks pretty good. Apartment land is, I think, going to be a disruption and an opportunity. Disruption for people that bought it who were leveraged before interest rates went up, and an opportunity for people who may be able to pick it up at a better price. Okay, so we look forward to the next year. Rod, next slide. If we look forward to the next year, you say, like, what should you be doing? Well, you know your business, but for our business, excuse me, 1 second. For our business, the number one thing that we're going to do is stay in traffic. You are going to see many more webinars. You're going to see more books written, more articles written, and more seminars done, and more speaking and podcasts and things like that done. I think for people who are transactional by nature, staying in traffic, keeping your clients informed as to what's going on is probably the most important thing you can do. And you may not have that much transactions to do anyways. This would be what we think is a smart thing to do. The second thing is affordable housing. The speed at which this affordable housing movement has moved. Most of you know what Doug Ford is doing in Ontario. Other provinces are following. There's probably more to come. This problem has to get solved. Whether it's done effectively or ineffectively by government remains to be seen, but it has to be solved. So we think that affordable housing will be a growth option. We've done 700-800 feasibility studies. Nobody asked us to ever look at the affordable housing option. Today, every study we do, people ask us to look at it. So, and then that comes to the earlier point you made about recapitalizing new apartment construction. We think Alberta seems to be bucking the trend in the rest of the country. Cap rates were already higher in Alberta, so the squeeze isn't as much. Development charges are lower. A lot of it is wood frame. It's just a lower tax jurisdiction. I mean, Alberta developers are facing the same problems every developer is facing, but there's just less regulation in Alberta to start with, and so on. So we think that Alberta may be a bright spot in the country in the next year. And we're working hard in Alberta with apartment deals. I'll talk about that later on. Land may be available now at the right price. And we see selling land, but I think if you're a broker or a seller or some kind of financier, you could waste a lot of time trying to sell overpriced land. I don't know if there's any buyers for overpriced land at last year's price. I think people are looking for bargains. And six, the education business for us, it's a significant part of our business, not from a revenue standpoint, but certainly from a staying in traffic and building your brand and so on. So this is what our plan is for the next year. Okay. We got two sessions. I'll go back, right? I forgot to mention that. We've got two new sessions that we're doing next year. One is we've noticed a lot of our clients who build apartments are also condominium developers. And those condominium developers are bringing projects to completion now. They're turning over to the buyers. The buyers are investors who are using them as rentals. And they're finding that, the rental market, while it's strong, it's still difficult, right? And so we're running a course called Condo Rental University. And Condo Rental University really is for condo developers and the real estate agents and the investors to learn how you rent a condo. We're experts in leasing apartments. It's not that different to lease a condominium, but it's got some certain nuances to it and things like that. We also think that when we look back at previous downturns in the economy, because commercial real estate is going to probably slow down, that people are going to look to pivot. And we think that this might be apartments are going to be probably the softest hit of all of them. We're going to teach a course for residential agents to switch over to commercial. We'll be hiring staff the next couple of years. And we think one of the best ways to hire people is to train them before you hire them. Okay. And so we're running a course on March 23rd for I think it's 3 days. Yeah. Teaching developers or teaching real estate agents the benefits and how you would pivot to the commercial real estate industry. Okay, Rod, next slide. So here's a tough question. We've talked about inflation. We've talked about interest rates. So I'm going to ask you this question. You can pop an answer in the chat box. If inflation is 8% and interest rates are 5%, next year, is your building worth 3% more? So inflation's 8%, interest rates are 5%, that delta is 3%. After 1 year, is your building worth more? That's a really hard question. So I've asked that question to a lot of smart people. Nobody has a definitive answer. Nobody's got one here either. And I think that sort of the best answer I got was yes, but not next year, meaning someone's not willing to pay me 3% more next year. But at some point in time, when your apartment building is below replacement cost, at some point things do catch up. So in 1, 2, 3, 4, 5, 10 years, replacement cost does catch up with inflation, and we've seen that happen in the past. So my argument would be for people who want to think this way is that if we have high inflation, interest rates are below, then apartment building values are going to go up. It may not be measured in year 1, year 2, year 3, but if you're taking the long-term view, the 10-year view, the intergenerational family view, then that may be the case. Okay, next slide. So new apartment construction, has been fairly strong for the last 10 or 15 years in Canada. It was certainly picking up steam, right? A lot of people were pivoting over to it, developers who were hotel, office, home builders, condo builders, and so on. Well, with higher interest rates, that has impacted on it, pretty significantly, but affordable housing may still make sense. Okay, and we're going to be doing a conference on affordable housing a little bit later this year, just dedicated to affordable housing. And I think the way to think about affordable housing is, don't think about the gross amount of money you're going to make. So you could build a $100 million conventional apartment building and sell it for $120 million. So you make a 20% margin on it. And maybe you'd have to put 20% cash into it, right? So you'd 2x your equity. Now, if you build that same building as an affordable building, it might cost you $100 million to build, but it might only be worth $108 million. You go, well, why would I build that? Well, because you only needed $2 million in the deal. So you 4x your equity, right? Plus you fed your machine, plus you got your development fee, your construction fee, and things like that. So we think that there's going to be a fair bit of affordable housing built. Affordable housing isn't even such a good word. I mean, it's below the market rate, but it's not like, social housing the way that, affordable housing implies. So keep staying on this. There's more government programs to come. The current programs are scattered. They're not aligned. It has to happen because the problem is large enough that it will. Okay, Rod? Our conclusion is, for maybe one of the best opportunities this year, is to creatively inject cash into existing development deals. These are fundamentally good deals in good locations with a good developer, with a story, with a pipeline, but the deal just got more expensive than they originally planned. And I think that private money is in demand. It's going to be in demand. And I think that private developers are going to be looking to private people to recapitalize the stack. And we've got a number of those files already on the go. It's very difficult to know how many apartment deals are going to be offside or going to need cash. But I think the smaller the developer, the higher the leverage already, the value may have gone down. That person is going to need help. It might not have hit the bank's radar screen yet, but typically when we're talking to developers, it's before they get their loan, when we do the feasibility study, but then it's throughout the process. And what we're seeing is not necessarily what the lenders are telling us. There may be more stress out there.
You're still muted there, Derek.
Okay, sorry. Next slide, please. Yes. So overall, when we look at, next year, we think that transactions are going to shrink compared to previous years. I think when you look at the last quarter of 2022, and you compare that to the last quarter of 2021, I don't know if all the numbers are in yet, but you're going to see a significant reduction in the number of deals between those 2 quarters in the apartment sector. I suspect that's going to carry over into 2023. Buildings with existing financing are going to be more attractive for buyers to buy. 2 years ago, everybody said to us, bring us a building with no debt. We want to put long-term CMHC financing on it. Today, people are saying, yeah, I'd buy a building if it's got debt placed on it a year or 2 ago, because that was way below than it will be today, right? So buyers are being more selective, and deals are under more scrutiny when deals do go under contract, right? So if you need to sell next year, I think if you're prepared to take probably a lower price, and a lower price will come because there'll be less offers and less competitive bidding. If you're thinking of selling, use next year as a time to prepare your building for sale. Do the right things to get the building shining, do the right things to raise the rent, get your data room ready, and then when the market turns, ready to go into the marketplace, right? I think there's also an opportunity to purchase land at probably better rates. A few years ago, everybody wanted land that was ready to go. Today, people are saying, no, bring me land that's going to require 1, 2, 3, 4, 5 years of work, because they want to make that they want to make that land profit on zoning change. Okay. Okay, next slide, please. So I think that you're going to need to be creative to get deals done. I've done a few $1 billion worth of transactions, and it's hard to believe I've never done a second mortgage. Never. Right? Our future deals are going to have paper involved in it, right, to make the deal work. Real estate is a relationship business. And I used to hear this all the time when I first got in the business. And I sort of thought, no, I just got to understand the real estate. No, you need to understand the people, right? Especially when we're in challenging times. Staying in track is important. I think the mortgage fog that we're in with interest rates is going to be over. It's going to be clear what's going to happen. At that point, transactions will return, because everyone will say, okay, interest rates are now here, therefore cap rates are going to be here, and transactions will continue. 1 second. Alberta continues to be sort of what we just see as a bright spot in the marketplace for the reason I mentioned before, in that the cap rates were higher to start with. It's a lot of wood construction, which I think doesn't have the time challenges of building that concrete does. And then Alberta has strong population growth, strong income, a younger population, new people are renters, they're probably already higher income people, and so on. So we think that the Alberta market could suffer less or do better than other markets. So this is a friend of mine, Harvey Russell, and I don't think Harvey's on. I didn't tell him I was going to do this, but Harvey and I have known each other for about 20 years. We did 2 deals last year on a
Harvey is on.
Harvey's here? Yeah. Okay, great. So Harvey, yeah, turn your screen on. Harvey, say hello. So Harvey and I have been colleagues, and now we're friends for 25 years, and we've probably done 6 deals so far. We did 2 last year. We're probably going to do 6 deals next year in Alberta, both new construction deals, land deals, and forward sales. And for any brokers here, your competition is not the other broker, especially when they're geographically in a different marketplace than you. We really believe strongly in co-brokerage, and we think it's all about relationships, and Harvey has relationships on the ground. He's an expert in Calgary. He's been there all his life. This is all he's done. We have a back room, a research department, and a real connection in Eastern Ontario. And when we've taken Harvey's knowledge, his relationships, and we put them with our research capability, our knowledge, and our relationships, we've been able to do deals that otherwise wouldn't get done. And, sharing a check 50-50 is easy to do when there's a check there, right? And so I would just encourage people to think more about cooperation today as deals get harder. Thank you, Harvey. Glad you're here. Okay, next. We've talked about the education business, but I think I mentioned to people, about 7-8 years ago, I had a serious health challenge, and I survived it, and I'm better off because I actually had that, and I smartened up. And I've been working hard at, my physical health, my mental health, my spiritual health, my cardiovascular health, and things like that, and developed some really good practices that have helped me be healthier, smarter, I think, because more blood's flowing, and it's been a real journey. And what I found was that part of that journey was a few of my clients really took the initiative to help me. They didn't do a lot, but they just talked to me about what they did and so on. And I just found that having a community of people to help you on your health and ultimately your longevity was one of the key things to being successful in being healthier. So we launched last year on a small basis, the longevity club, and we run it every Sunday morning at 9 o'clock Eastern time. Look, nobody should be busy on Sunday morning at 9 o'clock. Okay. So we run this at 9 o'clock for 1 hour. There's no charge. There's no sponsors. There's no advertising. It's just people get together and we have a topic that we talk about. Okay. And sometimes we have doctors on, sometimes we have exercises to do. The last one we talked about, one of the topics was how to drink your vegetables, the importance of smoothies, and then how, when you're busy, you can make your smoothie in your office, and one of your staff can do it, things like that. So it's not about real estate, but it's real estate people, and it's done in a Zoom format like this. In Zoom meetings where you go in breakout rooms, answer questions. It's actually a lot of fun. It's just 1 hour. So we'd welcome you to join that. There's no charge. And Rod, maybe you can pop that into the link. We sort of, look, anybody can join. You can bring your wife, your friends, and so on. We sort of want to keep it to the real estate fraternity because we're real estate people, right? We mentioned we're running a session on Condo Rental University. And then right below that, March 23rd, we're running 3 sessions on pivoting from residential real estate to commercial real estate. We think that commercial real estate is just a wonderful business to be in, but it requires a lot of training and things like that. The seminar some of you might be interested in is on February 2nd, sorry, in about a month from now, on how you restructure new apartment construction deals. And then finally, we're running 3 sessions on affordable housing, the 24th, the 29th, the 31st of May. They're 3 2-hour sessions, and we're going to talk in detail about affordable housing. We'll run through some pro formas showing what the returns are using actual costs and things like that. And a lot of that session will be on financing because that's what drives affordable housing. Okay, right? Next slide. So, we've developed, and some of you may already know this, but a learning portal to teach people how to build apartments. There's a free section to it you can go and look at, and then there's a subscription rate that you could go. So this is for development companies who are typically pivoting to new apartment construction, and this is a training tool on all the aspects of new apartment construction, both for you and your staff. It took us 2 years to develop it. There's more than 100 modules in there of all the aspects of apartment development. Okay, Rod, next slide. This is interesting. We've always written books, but we've written a book this time that's aimed at the public. This is a mass market book. It's the self-funding house, rebuilding the dream of home ownership. One of the questions that I often hear parents say is, how will my children ever be able to afford a home? And quite frankly, the answer is your children need to become landlords. And the way they become landlords in the same home they live in is the self-funding house. So this is a book on mind shift change that people need to have to think of their house as their first house or their second house or their next house as a business that's going to generate revenue, that's going to self-fund the house. It was a great experience for me writing this. It was sort of the story of my life in my 20s when I bought a house and converted to a triplex. It was the self-funding house. It allowed me to buy a house easily, a bigger house than I could normally afford. And then as I got married and as I had children, I took over more and more of the house. And had I stayed in the house, as my children left, I might have converted it back again. At one time, I converted one of the units into my office and so on. So it's about a 2-hour read, 20,000 words, and it's out in January, called The Self-Funding House. Okay, Rod? The Self-Funding House is about mind shift. Then the second book coming out is The Blueprint for the Self-Funding House. That's how you actually do it. Floor plans, how you approach zoning and things like that. And in Ontario, we just had a big shift coming with Ford allowing, accessory dwelling units on single family home lots. And then the third book will be for the stakeholders of the self-funding house, for municipalities, for politicians, and for lenders, to make money available for people to convert their houses properly, legally, safely. And there's just so many benefits to doing the self-funding house, meaning you're going to add an accessory dwelling unit, a backyard unit, a garage unit, a basement apartment, and things like that. And I think it solves so many of today's issues. We need a couple of million houses built in Canada, or rental buildings built. That's not going to happen the conventional way. We could have an army of people. If a million, but maybe 7 million homes in Canada, if 10% of those people built basement apartments, there's 700,000 units. There's no way governments are building 700,000 units in 1 year. And it's bigger, faster, cheaper, easier. It's environmentally correct. The roads are already there, the sewers are already there, the hydro connection's already there. It's faster. It's affordable housing for the renter, because it's not a $5,000 rent in a basement. It's a $1,200, $1,300, $1,400 rent, or a backyard unit or something. I use the term interchangeably. And it also generates revenue for the municipality because with a legal basement apartment, you're paying proper tax. So if you're interested in that, there's a link in there. The book is, it's not expensive. It's an easy read. Maybe it's something for your children to read. Right? So I want you to take now a minute, grab a sheet of paper. I want you to think about, I mean, all of you are probably goal setters, right? It's the beginning of the year. I think the book is $20, okay? Write down the 5 things that you're going to be doing in your business in 2023. We're going to play a little music, okay? And just write them down now, whatever comes to mind. I'm going to share my 5 things in about 20 seconds. Why don't you pop the 5 things that I told you this morning that I'm going to do differently? You guys can type yours in the chat box if you want. So Rod, are you showing mine?
In 1 minute.
All right. We're almost done, guys. So number 1 for me was we're going to spend a lot more time with municipalities. Our business hasn't required us to interface with municipalities. And we find that dealing with smaller municipalities is easier than dealing with larger municipalities. The affordable housing crisis sort of is everywhere. Second is for me, spend more time in Alberta. We just see better opportunities there than we do in other places in the country. Certainly more webinars, more books, and more seminars, right? Talk to every apartment developer in Canada. I suspect that there are 1,000 developers in Canada building apartments at some stage of development. Not all have broke ground, probably less than half have broken ground. Many should. And then the last one is probably the most important one, stay in shape. You know, the longer you work, you know, the better you get at your business. I haven't seen a lot of great things about retirement. I have no plan on doing it for myself. So focusing in on longevity has become an important goal for me, and it shows up in so many places, and it shows up in your business as well. So those are the 5 things that I wrote. I'm sure many of you have already taken time to do this. Okay, Rod, last slide. So we're pretty much done here. We appreciate you joining us, and we do this every quarter. The next download, and we don't know what the world's going to look like, 3 months from now and how it's changed. The next download is April 4th. So thanks very much for joining us, and we look forward to seeing you again.